Hello, everyone, and welcome to the episode number 22 of JustDario's Cigar Time. Today, we are going to talk about how the Fed fell into a checkmate trap. But before we dive into the main topic of this week's podcast, it's important to have a clear picture of what happened into financial markets so far, in particular during the last week. Because to be frank, the confusion on social media and mainstream media reached unbelievable levels, and this created a lot of damage and sense of uncertainty in all the people following them and trying to understand how to navigate these very treacherous financial markets. The first very remarkable thing that happened this week was the fake headline that later on it will come out. It was actually not a fake headline, but eventually people within the White House leaking to a notorious social media account what would have been the potential upcoming decision from the presidents to pose tariffs in order to calm markets. But on Monday, this headline was quickly denied, and the brief relief that was given to financial markets faded very quickly. That kept falling significantly, both on Monday and on Tuesday. The most important event of the financial markets this week happened on Wednesday morning, Asia time, during the trading hours of the Japanese stock markets. The event in question was the near implosion of the US Treasuries markets, with at some point 10-year and 30-year yields starting to go vertical, with the 30-year yield briefly even breaking 5% and triggering all alarm bells in central banks across the world. With the Bank of Japan even hosting an emergency meeting right after Japanese cash trading close between themselves, the FSA, and the Japanese MOF in order to discuss and agree on countermeasures in order to start stabilizing financial markets. The domino effect of this specific event into the government bond market didn't take long to start reverberating across all the financial system, with in particular the UK government bond market being in the most vulnerable position, with at some point the 30-year gilt yield flying to 5.71%, above and beyond the level that triggered the pension funds and insurances crisis a few years ago during Liz Trust times. A small note about this. Why the crisis didn't go out of control right away this time in UK like it happened a few years ago? The answer is very simple. The Bank of England is already injecting emergency liquidity into the system through its short-term open market monetary operation facility that, as of now, has a balance of £60 billion lent to banks, but also asset managers, even hedge funds, that I would like to remind everyone, they are not disclosing the names. So these are kept confidential under the premises that they don't want to cause any quote-unquote unnecessary panic into financial markets around these potentially big financial institutions. Heading towards US stock markets open on Wednesday, the situation in the bond market that, let me be clear, is far more important than the stock market, was becoming more and more serious. But at that time, I already noticed something that, personally speaking, I didn't want to post on social because, it's a bit tiring, every time, give an heads up about potential events and machination and manipulation happenings in the market. And then if people don't see the headline on any mainstream media confirming that, then they believe that what you're saying, there is no counter proof. But as a matter of fact, what I wanted to flag at that time was that there was already a very awkward bid for stocks, in particular US stock future during European trading hours before US stock markets started to trade. Furthermore, despite all what's happening into the bond market, there was selling pressure onto the VIX. It was a bit counterintuitive. And then effectively prompted me to think that a news was potentially coming and relieving a lot of stress from financial markets very soon in order to contain the fallout that started during Japan trading hours. Fast forward, something incredible happened on Wednesday. The president of the United States, Donald Trump, in a move that will find its way into the history books, posted on Truth Social, this is a great time to buy stocks. And this happened 3 hours before the White House officially announced a 90-day pause to the tariffs towards all countries around the world, with the exception of a base 10% tariffs that remain in place, and with the exception of tariffs enforced on China. This triggered an incredible buying stampede into stocks, with the likes of Nvidia, Apple, Microsoft going up 10, 15, 20% by the close. Was the third biggest one-day rally into history. And by the close, everyone, even the people that criticized President Donald Trump the most during the previous day, were cheering on him on how he pulled off a great heart of the deal move and blah, 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 kiss, 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 kiss on his ass. But unfortunately to them, this relief didn't last long, because forced liquidation and margin call started to resume, driving the JPY to US dollar rate down again from 147, where it jumped right after the White House announcement, down to 145, 144. And after it broke that, it started to fall like knife through warm butter. It's a sign that the implosion into the JPY carry trade effectively resumed. Stocks didn't take long to react, and yields couldn't ignore this either, because potentially this time around, US government bonds were the assets that saw the highest amount of selling induced by forced JPY carry trade unwinding. All in all, this week, while from one side recorded one of the biggest gains in stocks in a long time, also recorded one of the biggest jump in yields since 2001. And all in all, since the trade wars started, dollar is down, the value of US treasuries is down a lot, and yields are high, and stocks are much down. If you compare that with Chinese financial market, that clearly is the biggest antagonist, the biggest target of Donald Trump, objectively speaking, the US is losing. And perhaps is losing because, differently from China, where the PBOC tends to be aligned with the government, Trump in his own mind thinks that the Federal Reserve is not being playing ball and supporting that much Donald Trump effort. The president didn't make any mystery about his willingness for the Federal Reserve to cut rates immediately. But on the other side, the Federal Reserve is still dragging its feet. And honestly, they're not that wrong in doing that. Reason why the president is effectively ending up forcing their hands and in keep increasing tariffs towards China and keep rolling the market with his actions is effectively putting the Fed into a situation that if they don't want to cut rates, they will have to bail out banks once again. And this situation is actually gaining more and more chances to happen because of the disruption and damages that we saw into the fixed income market, and especially in the US Treasuries market this past week. I hope now it's clear for everyone how the Federal Reserve is falling into a checkmate trap. And now I want to continue this podcast discussing on what I believe are going to be the actions that the Federal Reserve is likely going to take in the near future to stabilize financial markets and in particular to strengthen the banking system. In these regards, the move that makes most sense to me right now, looking at the condition in the market, is for the Fed to reinstate the BTFP facility that stood for Bank Term Financing Program. Let me remind everyone that this facility that helped to bail out the US regional banking system was put in place in order to inject liquidity into banks, taking from them US treasuries at collateral, not at market value as it is supposed to happen, but at par value. This is a very subtle difference, important to understand. Why? Because if the Fed takes collateral at market value and inject liquidity, that doesn't change the structure of a bank balance sheet. But as a matter of fact, if the Federal Reserve takes those bonds at par value, it implies a gain, a temporary gain for the bank. And this gain is nothing different from a direct injection of capital into a bank balance sheet that results from higher profit from that trade. So not only the Fed is injecting an additional amount of liquidity into the financial system, effectively expanding its balance sheet again, but hey, let's not call this quantitative easing, okay? It's a temporary facility. Okay, fine. But it's effectively providing a temporary injection of capital through profits because these banks are selling bonds at a much higher value than the one they will get from selling those bonds in the open market. Furthermore, the BTFP can be accessed not only by institutions in trouble, but potentially speaking, by everyone. Reason why another benefit from BTFP 2.0 will be to help those larger financial institutions to free up some of their balance sheet, get liquidity plus an additional injection of temporary capital on the back of them going back into the open market and provide liquidity again to US Treasury in order to help reestablishing the normal functioning of that very important part of the financial system and putting volatility in that area under control with eventually cascading effects on the risk and volatility on all the other asset classes sensitive to rates. Will this move from the Fed be enough in order to avoid further turmoil into the financial system, restore stability, and then, as it happened in 2023, spark another great run, especially into stocks to new all-time high? I'm afraid I don't think this is going to happen because the current situation is very different, and I'm going to explain you why. As of Friday, China raised its own tariffs to all imports coming from the US to 125% as a retaliatory move towards the United States that increased tariffs for any imports coming from China to 145%. Furthermore, there has been already other action that trickled down into the news already. And in my opinion, the most remarkable one was Tesla stopping any booking for Model X and Model S out of their Shanghai operation, in a sign that China not only is retaliating from a general perspective, but it's starting to retaliate on a specific company perspective. And on this front, China, as I explained many times in my article during this week, has far greater leverage at the negotiation table than the US. So all in all, there was a big miscalculation with regards to China financial and economic resiliency in case of US tariffs started to be imposed on them. Because as a matter of fact, not only they didn't cave, but they are fighting back and they are willing to fight till the very end. In a stance that, logically speaking, will prompt US President Donald Trump to escalate the fight even further. And in my opinion, it's not going to be a fight on tariff wars ground anymore, because clearly US is not in a strong position this time around. Something confirmed by the fact that the White House just announced an exemption from tariffs for all companies importing phones, computer, semiconductors, and all other sorts of electronic goods into the US, showing how vulnerable effectively the US is from cutting off the supply chain present in China, and from which all its key companies and leaders in financial markets like Apple are strongly dependent upon to maintain their profitability and their share prices at the currently overinflated level. Now the war is going to be shifted towards capital markets. And here we can really see the triggering of an unbelievable mess. In particular, if Donald Trump goes forward with his plans that have been already leaked out to mainstream media to provide a warning to all traders out there, with plans about delisting all Chinese ADR stock from US markets. A move that, of course, will be a direct hit to the value of major Chinese companies and will definitely impair the liquidity in the financial markets that these companies can enjoy right now. But as I warned many times, the president needs to be very careful here, because the holders of all these ADRs are not Chinese investors, but the majority of the holders are US investors, followed by other foreign investors. And in such a move, the president might risk triggering a bigger chaos, especially into the hedge fund industry, where you have the likes of Ray Dalio, David Tepper, that right now are overly exposed to Chinese stocks. And the domino effect from damages and margin calls being prompt because of a sudden collapse in value of those holdings held by hedge fund might even reverberate to the infamous US Treasury's leverage arbitrage position that the very same hedge funds in the US built through the years to the point they became clearly unmanageable and that are posing a greater and greater risk to the US government bond market. And I don't think anyone is taking into consideration these events at all. A series of forced liquidation in these hedge funds portfolios and then triggering investors asking for the capital back might cause a forced unwinding of this ginormous US Treasury's arbitrage trade, with consequence in the functioning and the liquidity into the US government bond market that can be completely catastrophic. Once again, showing how, potentially speaking, even on this front, the United States and the Western markets are way more vulnerable than Chinese one, differently from the Western world and governments that kept feeding the bubble through helicopter money through the years. Chinese government very actively forced the bubble to pop, first in 2014 and 2015. Then a bubble was created in the real estate sector that once again was forced to pop by the Chinese government. And when there was a threat of another bubble forming in stocks in 2021, the Chinese government rugged stocks once again to make sure they remained at fair valuation and attached to the performances of the real economy, without the risk of them becoming a weakness in the Chinese financial system and potentially a vulnerability that could have been used in case of a worsening in the relationship between China and US. Let's assume that the United States moves ahead with listing all Chinese stocks from US markets and an incredible chaos erupt from there. Here, I expect the Fed to lead the charge of central bank intervention once again. And let's not forget that the key for financial market stability are bonds and banks. And one of the parameters that the Federal Reserve tracks very closely are credit spreads and credit default swap spreads. Reason why I believe that if we end up in such a situation, the BTFP 2.0, that by that time would be already in place, might be upgraded to BTFP 2.1, including corporate bonds, in a move very similar towards the Fed already did during the 2020 crisis, when they had to take away from banks' balance sheet trillions and trillions of radioactive assets at their time, not only collapsing US Treasuries, but also mortgage-backed securities and corporate bonds, in an ultimate move signaling the increasing fragility of the Western financial system. Here, I want to conclude today's podcast with explaining why, basically, in no scenario whatsoever, as you can see so far, stocks into Western financial markets can recover in the same way as they did before, especially during the previous banking crisis of 2023. I'm saying this because clearly the US government cannot rewind all it did in the past 2 weeks and take away all tariffs, resets, the whole situation. Clearly, such a move would be a disaster from a political perspective, and many countries will start then questioning the real power and influence of the United States in the current world, global economic and financial setup. So tariffs are here to stay. They will keep going ahead. Perhaps there will be some deals and negotiations. As I say, there is a higher chance that tariff war against China will escalate into a capital wars, because so far the US financial markets in particular have been performing so much worse than Chinese ones. Reason why there is really no narrative available from the White House that what they've been doing so far can be claimed as a victory on any front. People are in total disagreement with that. So overall, the global economic system is going through a structural change that will inevitably impact the margin and profitabilities of many companies out there. In particular, the very large corporations like Apple, Nvidia, Microsoft, and so on and so forth, they benefited the most from the globalization trend that we saw in the previous decades, effectively allowing them to shift all their supply chain and production to very cheap countries and extracting the highest possible prices from their customers all over the world, especially in the US, for the benefit of their own shareholders, and to increase the value of their stock prices towards level that, frankly speaking, I don't think we will see ever again for a long time now. Potentially for a very long time, since right now many investors are seriously questioning valuation multiples and whether all the multiples that have been justified so far by all the narratives that led into these situations were appropriate to begin with. And frankly speaking, I believe that everyone is going to come to the same conclusion that going forward, investors will be required to be more cautious in order to protect their capital, to perform, and to avoid significant losses in their asset under management, on their own personal finances if it is retails, or on their client assets if it is pension funds or insurances eventually. So lower margins and lower profit plus collapsing valuation to what is nothing different from the long-term trend will be a significant burden on top of stocks, especially on those stocks that enjoyed completely unjustifiable valuation till not long ago. And I don't foresee anything that can change the situation whatsoever. Not even an incredible amount of money printing from central banks, because all that money printing right now is hardly gonna find its way back into stocks. Might inflate bubbles elsewhere, might send prices of hard commodities and precious metals like gold to the stratosphere and a sign of fiat monetary system failure, but certainly speaking, people are going to look for alternatives than stocks in order to earn positive returns in increasingly future uncertain times. Thanks a lot for having listened to me once again today. Thanks for liking, commenting, and subscribing on these videos and on my channel. Thanks for the support on X, following there, for reading my article on JustDario.com, and helping me to continue doing what I do in the best interest of providing you with objective and biased information to navigate these more and more difficult financial markets. Ultimately, with the goal of limiting damages as much as possible. Why not even profiting for those that are still eager to trade into this market, but ultimately to come out strong from these difficult times and be in the best possible position to ride the next economic cycle that is ahead of us, and ultimately can result in an opportunity to build generational wealth if the right decision have been taken prior to that. Have a nice weekend, everyone, and talk soon.